check where we are. We're good to go. You guys are good to start. Thanks.
I'm Liam Stewart. I'm a financial analyst.
I'm Dave Johnson, financial planner.
I'm Nick Schulte, I'm a certified financial planner.
Luke Gainford, financial planner. So we're gonna go over the family bank for you guys and how we're gonna move forward, how we think you guys should move forward with your financial situation.
Yeah, so we just want to start the basic Garcia family plan for you guys. So this presentation will really just serve as a roadmap for the Garcias, your guys' financial stability. You guys have $124,000 in gross income, $102,000 and $100 in estimated net worth, $8,652 estimated in current expenditures, $5,650 in credit debt, and then $80,400 in retirement funds saved so far. So this is kind of a roadmap for the basic things about financial stability. And then for another kind of more like brief financial snapshot, so right here we can see we have assets. So we have home equity at an estimated $81,900. We have Miguel, your Roth IRA at $62,000. Sophia, your Roth IRA at $18,400. A combined checking and savings of about $4,450. Miguel's 2018 Ford F-150. We put in an estimated $20,000 through a bunch of different research on where that would be with the wear and tear it has on it and everything like that. And then with the estimated equity on Rosa, your 2025 Ford Explorer, we have about $5,000. And then lastly, the proceeds from Rosa's home sale, we have it at $150,000. So that's all for our assets, right? And then we have our liabilities. So the balance in the mortgage is almost at $200,000 at $198,000. The Ford Explorer loan, we have at $36,000. The Capital One credit card debt is at $4,200. And then lastly, we have the Amex debt at $1,450. So for our estimated assets, we have $341,750. Then for the estimated liabilities over there, we have $239,650. So really, we have an estimated total net worth for the family of just over $100,000 at $102,100.
So the first point we really want to touch on is the issue of the house. Do we renovate the basement or do we move entirely? From our research in the market area around Sterling Heights, the current interest rate on the loan is 4.25%. And in Detroit, Michigan, generally on a 30-year fixed interest loan, a new loan would carry a 6.125%. So it's far exceeding the current rate. Assuming that the basement does not have an egress window as it is, one would be required to be added, and the average cost of adding that in Sterling Heights would be approximately $15,000 to $20,000. The additional bedroom will add value to the home down the line when it is ready to be sold. And with Rose's $150,000 in home sale proceeds, and seeing as her moving in is what required the additional bedroom, our conclusion is that the best step forward is basement to be remodeled so that the 4.25% interest rate can be kept, and the renovation will be paid for with Rose's money, so it doesn't incur any more debt.
So there's a few ways we could go about this. One of the first ways is that Rosa could just pay out of pocket for this renovation. You know, that's the best way. You don't have to take out any other debts. But another way we could do this to kind of make it cheaper, we could take out a HELOC loan, and that would help, you know, finance. So a ton of money isn't coming straight out of Rosa's pocket. You know, with that though, we are incurring another debt. But that's just another option, you know, you can look at.
So staying on the topic of Rosa, her healthcare is a very important need, I understand. So we want to keep Medicare Parts A and B, which covers hospital and medical coverage, keep that for $175 a month. We want to add Part D for prescription drugs for about $45 a month. Another plan we want to add is a Medigap Plan G, which covers all out-of-pocket costs for Parts A and B. So we really just want to secure everything, make sure we're not paying anything extra than we need to. So it costs about $200 a month. We want to use Miguel's HSA for eligible purchases like equipment and non-covered prescriptions. And we want to keep Sophia at home as a caretaker for Rosa, which saves about $2,500 a month on a part-time caretaker. And the monthly impact, for changes is about $245 a month, and annual impact changes is about $2,940 a year.
So I know, Mr. Garcia, that one of your questions is you didn't know about HSA. So we are going to touch on that later. Like we said right here, we're going to use your HSA for eligible purchases. So we are going to clarify that a little later on. And then, Rosa, with your Social Security survivor benefit, you're pulling in about $3,000 a month from that. And then we know you have your cash. You're trying to keep your cash set aside. We have other plans for that, for the whole family. But with your benefit, we'll also touch on this later. We are going to have you, kind of pay for your own things. So, we're the family, like, everyone's living together. So, everyone's going to work together on the expenses, but, you do technically have your own income, so you are going to have to pay for some of your own things. So, one thing we just touched on, Rosa's healthcare needs, is, Mrs. Garcia's career. So, we know that you have your home bakery. We think it's best for you to stay here. I know that you were thinking about maybe, getting a new job or scaling down the bakery, but you pull in a significant, portion of, the household income. And considering in the future, Rosa's healthcare needs, having an at-home caretaker can cost anywhere from like $35 an hour, which is just unrealistic given, your current budget. So we think it's much better if you stay at home. We'll have one of the kids move down to the basement, and then Rosa can stay upstairs. Doesn't have to worry about the flight. So when that health becomes a challenge, you can be there to kind of assist. And then another big part of you staying at home is going to be, Mr. Garcia, your food. We know that you love to eat out at Chipotle. So one of our, plans to help cut down on your costs is to have Mrs. Garcia food prep every day. We can bring down that $13, $14 Chipotle bowl to like a $5 or $6 meal each day, and that adds up over the course of the year. Another thing we're gonna have Mrs. Garcia do, we're gonna have you open up a SEP IRA. So Mr. Garcia has a Roth IRA. What you're gonna do is with that SEP IRA, you'll be able to contribute up to 25% of your net income from your small business. Now, with your current income, you won't be able to contribute that full 25%. But I have planned out a good chunk that's gonna help you build up that wealth, so we can talk about retirement in the future. So the next thing we want to talk about is the vehicle strategy. I know Mr. Garcia that you have, 2018 F-150. It's getting a little older. You said you want a new one, and then we have Elena, which is 16, wants a new car. So looking at F-150s in fair condition, they go about $20,000, for 80,000 miles. So what we want to do is we want to trade that vehicle in for a 2025 Ford Maverick. Those go for about $30,000 with low mileage, right? So that gets you a new vehicle. It's going to be reliable. You're still going to keep the truck. We plan on getting a hybrid. We think that would be the best for you because that's going to cut down your gas costs. That's going to save you a couple extra bucks every month. So if we do a trade-in at 5% for 36 months, that'd be a $300 monthly payment. So after 3 years, you kind of get that out of the way. That frees up $300. The next thing we want to talk about is Rosa's Explorer. Rosa, you only drove your Explorer 4,000 miles last year. So to have a $40,000 car, I don't think it really makes sense in your current situation. I think there's a better way we can allocate that. So we think that it's best to sell that Explorer. There's about $4,000 to $5,000 in equity you can get out of that. And with that, you can get Elena a decent car, She just turned 16, new driver, driving is questionable. So get her something, that she can beat up a little bit with that. And then we think that financing a RAV4 or another SUV for the family is the best choice to go. It's gonna bring that monthly payment down from $663 a month to $459. So you're saving about $200 there. It's also probably gonna be more fuel efficient, seeing as it's a 4-cylinder SUV and not a V6.
Now, I think another important topic to cover is you guys' insurance. So, Miguel, we want to replace your whole life insurance with a 20-year term life policy, which is around $78 a month for $500,000 in coverage. We think it's the best plan of action for you guys, considering your lifestyles and everything. Sophia, we want to add a life term for you, $250,000 for around $40 a month. And Rosa, we want to save on the life insurance, given the current stability of your health. I think it's the best option for the finances. And speaking of the auto insurance we were talking about earlier, we want to combine that. It's going to be about $333 before, and with our combination, it will be around $650 a month after.
That also incorporates the cost of adding a plane on. Having a new team driver, it about doubles rates here in Michigan. So looking at, switching to fully Geico or something like that might help out, but adding a team driver is where the expense is coming from.
Yeah, and we also want to increase your guys' underinsured coverage to $100,000 minimum for safety. And Miguel, we want to contribute $200 a month to your HSA, so funds can grow tax-free and you can pay medical bills in the future. This is going to free up about $113 a month, and it will add over $650,000 in additional protection. So we think this course of action will super great for you guys' family.
So, kind of looking at finances, I know that you guys have separate checkings and savings accounts right now. I also know that, Mr. Garcia, you have a credit card, I believe it's your Capital One, that you use for both personal and business expenses. So that's a big issue right now. We know that you're expecting about $5 grand back in tax returns. We think that in the future year, if you can separate, your business and your personal expenses, you'll be able to increase that tax refund, which gives you a little bit of extra money at the end of the year. So we want to start off by paying the credit card debt. That's the biggest issue. Both of your credit cards, you have a small balance on, it's about $5,600 total, and they're sitting around 23, 25% interest rate, so that's pretty high. So that tax return should be coming soon. Taxes will just due on the 15th. You should have that back in about a month. So with that tax return, we want to put that straight towards the credit card debt, and then we also want to take out of your current savings to pay that off. That credit card debt, snowballs and snowballs, you just need to get it done with. So you'll probably have to pay about $1,200, $1,300 out of your personal savings right now to get that eliminated, but once that's gone, it's going to ease up on a lot of pressure. The next thing is we think you should open up a joint account for daily expenses and bills to pay. Having one credit card that you put all your bills on, your daily expenditures, it's going to be a lot easier to track your current expenses and not kind of have things all over the place. And then you currently don't have an emergency fund, so we think the best course of action here is to open a high yield savings account. We're going to start by trying to get 3 months of expenses, which is going to be about $15,000. Some good options are with SoFi online. We think that you should separate this bank account so that if you need money, you're desperate, you don't pull from your emergency fund. We're going to try to add $1,500 a month. We think that's the best for you. It gives you a little bit of a buffer if something comes up unexpected. You lose a tire, you have money in there. Obviously, we want to get that full $15,000 in there first, but it's all right if you got to take from it. And then, like I said earlier, opening up a separate account for those business expenses is really going to be big, especially when taxes come.
So college savings is a big question right now. Obviously, Elena only has 2 years to save for college, and this essentially removes the idea of their compounding interest in any accounts opened. Mateo fortunately has 6 more years to build this interest, and that drastically changes the approach to make this saving most effective. The first step for both children should really be opening a 529 investment account, and this is where all that savings money will go to. 529 plans are triple tax advantaged in Michigan. So not only does this provide a place to save the money, but also a positive externality to the Garcia family, as they can take advantage of these tax advantages and use deductibles. This is up to $10,000 in your Michigan State income tax from what you contribute. For Elena, any contributions are essentially saving cash due to the timing constraint. Obviously, this should be put into the 529 because of the taxes. And so the safe low risk investment strategy for the 529 would be recommended, so we can allow for small growth in the account. But it also ensures that the money invested isn't lost in case the economy takes a large turn. Some low risk capital preservation would most likely come in the form of bonds and cash. These are low risk, liquid investments. Mateo has significant time to grow his investments beyond capital invested, and that's in the 6 years. A modest investment strategy is highly recommended for the time frame because it is still not a huge amount of time, like 18 years. Some key strategic points would be avoiding a 100% equity investment portfolio, as this carries the high risk and can be lost quite quickly. Recommended asset allocation would look like a 55% investment in stocks, 40% in bonds, and 5% in cash. The equity ratios for stock investments would look like 70% in large cap investments. These are safe, high market cap, large companies that aren't gonna have any financial issues. 20% in medium and small cap, this is where we see a lot of growth, but it carries the burden of bankruptcy. And 10% in international equity for global diversification. So global markets change at different rates.
One thing we are going to touch on, I think it is a big ask, but Rosa, we think that if you added $10,000 to each kid's account initially, that'd be a great baseline to start having them build wealth. Like I said, Elena is basically going to be cash, so if you set aside that money already, that's going to be a good buffer for when she gets into college, and that initial investment of $10,000 for Mateo is going to be able to grow significantly in the 6 years.
So for retirement planning, the big question is, can they retire before 65? And the truth is that we probably won't be able to retire before 65, but we can take steps to get there and wait till get there by 70. So one of the key points is wait till 70 to take out any Social Security so that we can take full advantage of the benefits and not have to pay the large taxes before then. Maximizing 401k contributions is big. We can take advantage of the 50% employer matches, and this is tax-free contributions that it pulls straight from the income, and it doesn't have to get taxed twice. Sophia should be in an 80 to 90% equity in her retirement account, not bond markets, as this is we have time to grow in 20 years. Open an SEP IRA for Sophia. We already touched on that. Self-employed IRA, since she has her own business, and this is more tax deductions. We can max out Miguel's Roth contributions, as he's not currently doing that. And yeah, 65 is unlikely, but legal retirement age of 65 is possible, but we'd like to wait till 70.
Yeah, so we know that currently, Mr. Garcia, that you're putting about $100 a month to your Roth IRA. So one of our big points is that your employer matches up to $4,000 in investments into the 401k plan. So each month we're going to be investing in that to get that full benefit. We're not going to be maxing out the 401k, but we're just going to meet it where the employer matches, and then we'll also be maxing out the Roth IRA at like $667 a month.
Alright, so for additional urgent concerns that we haven't already touched on, we have the HSA enrollment. So HSA funds, contrary to what Miguel you stated before, are not forfeited at the end of the year if unused. This rule specifically applies to FSA, which is the flexible spending accounts. HSAs roll over, invest, and then grow tax-free. So we want to make sure you know about that. We have additionally $0 dedicated towards the emergency fund. Your family has $44.50 in liquid savings, none of which were dedicated towards that emergency fund, which is really important. A family of your size should at least have $15,000 saved for medical, home, appliance, and just basic life emergencies, diversified from funds from Rose's proceeds. They contribute at least $500 a month from there. And then lastly, Miguel's credit is at 670. So this is a relatively low credit score, so we want to boost it up as much as we can. And then important concerns, we know Miguel, you wanted your Lions season tickets. Not purchasing the Lions season tickets is the most fiscally responsible choice, at least this year. I know that would be a shocker. Sorry about that, but especially with the exponentially increasing price for season tickets in the past 3 years, this should be revisited in 2027 once the emergency fund new budget and debt elimination are in place. The trigger smoker, yes, but not now. But once the debt's gone, then purchasing it with cash and not with credit would be the best option. And the Mateo's phone, we think the Mateo can get a new phone, just not on the comparatively expensive Verizon family plan. Consider instead a basic device on a low-cost carrier like Minimal. And then extraneous expenses and additional information. We have subscriptions, so cutting Netflix and Peacock. Phone bill, add a new phone line, add Mateo, it'll drop price per line. Gym membership, we have one Black Card membership, regular. Sophia's Amazon spending, try to drop that to $25 per month. Miguel's coffee, make the coffee at home, and cut that everyday easy Dunkin' costs. Miguel's lunch, we already talked about this, but meal prepping for lunches instead of doing the takeout every day. And then lastly, family eating, limiting it only to one meal out per week, whether that's on the weekend or whatever. No DoorDash, because that's a really expensive cost if you need to takeout.
So this is kind of a look at your current budget. So current expenses, you have your mortgage, your car payments, your insurances. We know that Traverse is up in a month, so that $1,165 in car payments is about to drop. We know we are going to take on the new loan on that REV4 or other SUV in that area. So your current expenditures are about $8,652 on your net pay of $1,100, including Rose's Social Security survivor income. So our goal for you guys, where you should move, you are going to be spending $10,398 a month, but I want to hit on these points right here. Your retirement account, Mr. Garcia, we're going to have $1,250 a month going towards your Roth 401k. Mr. Garcia, we have your retirement also at $1,250. That's going to be going towards your SEP IRA. And then we want to head into that emergency fund. So we are spending, or you will be spending about $2,000 more a month, but this is $4,000 roughly in investments in your retirement that you're investing in. So the main points we want to hit on, where we want to cut down, is you have a lifetime membership right now. Lifetime, great gym, but how much you work, all the needs of the family, it's hard to use everything at Lifetime. It's very expensive. So we think something like Planet Fitness, you can get a Black Card, that way you can take Mateo with you, and then 3 basic memberships. It's going to be $55 a month. That's $350 in savings right there. And then we have eating out. You guys love to go eat out. You know, I get it. It's great, but cutting it down to having home cooked meals, you know, that could be a reason to justify getting the trigger. I know that you guys had like an argument about that. Bringing that food and like family back at home, it's really gonna cut down on meals. Instead of spending like $22 on a meal per person, 4 or 5 times a week, 4 weeks a month. If you have like $7 meals, you're cutting out money so quick. So bringing things back to home. We don't want to eat out as much. We want to cut that out. It's bad spending. Bringing it home, you get it grows a family, and that's really the saving point here. So where we'd like to see in a couple months is have a lot more money going towards your retirement accounts, and then bring down those like not needed purchases, like getting lunch every day at work or getting coffee in the morning. Having someone make a coffee at home, you go from $6 a coffee to like 30 cents. So it saves money. So with our goal for you guys, where we think you should be, you'd be bringing in $1,100 or $11,000, sorry, and your plan expenses would be about $10,498. That does leave you with $740 in freed up money right now. So I know that there's a few things in here, college funds. There's things that are a little hard to manage right now. But once we get this baseline emergency fund out of the way, we get that credit card paid off, you're gonna be doing so much better. So hopefully in a year or two, you'll have a lot more freed up money. Those expenses are gonna be freed up. You're gonna have that credit card debt gone. We're gonna make sure that's a big thing. Pay off your credit cards in full. We know that you like the buy now, pay later method. It's not great. You think it's good. It gets you what you want now, but it ends up leading to $5,000 in credit card debt, which most Americans are in debt. So like $5,000 you're doing pretty good, but we just gotta cut out like some bad habits. You gotta work on staying at home, spending at home, not going out to eat.
And then this is just kind of a wrap up, kind of saying our priorities based on where we're at with your family's finances. So we got the contributing to the 401k for Miguel, open the joint household checking account, auto pay for those fixed bills, apply that tax refund to the credit card debt upon receiving that tax refund. Miguel enrolls in the HSA, rebalance Sophia's Roth IRA, and then we add around $10,000 from Rose's funds to the emergency fund, open MESP accounts for Alana and Mateo with $10,000 from each, $10,000 each from Rose's funds, open the dedicated business checking account for Sophia's Bakery, vehicle plan, we have that, and then decline the line season ticket renewal for the 2026 season, acquire the renovation quote for the basement conversion, we consult out medicated plan improvements.
We're good. All right. Give us a chance. We got a few follow-up questions for you. Yeah. A lot to do, right?
Yeah, that's a lot. Great job.
When's all this due? By the end of the month? April 30th? Holy cow. So,
No, you guys not.
no, all good. Very, very comprehensive for sure.
Yep,
So,
yep. I do have a question. Can we jump right into
no,
that?
please, Andrew, go.
Okay, so I noticed you were asking Rosa to put basically $20,000 of her savings, or what she had received from her home, into the kids' education accounts.
Yes, ma'am.
And then $10,000 going towards that household emergency fund.
Yeah.
Is that correct?
The emergency fund, possibly, it's kind of up to Rose's discretion,
Okay.
We know that the kids' education is a big priority.
Sure.
We gotta start building that while we can,
Yeah.
especially since it's tax finished, you can write it off.
Yeah.
The emergency fund, I mean, that would be optimistic to get that in there in case anything happens, but it's
Yeah.
not.
Yeah, okay, perfect. And then with the remainder of that, I just wanna make sure I heard this right. You're, suggesting we utilize that for adding the third bedroom, for the.
Yeah, so like we said, the bedroom would be about $10,000 or $20,000. It depends if you have an egress window. That is a safety thing. If you do have one, that makes it a little cheaper. If not, you can add one, not too much. But we want to keep the rest of that money, the $150,000 for Rose's healthcare needs. We know we're looking at new insurance plans for you guys, but just to have that money as a buffer for her. It's good.
For the
Touch on
basement,
exactly what I was gonna.
we just want to say that we assume the $20,000 for the basement is going to be far cheaper than any retirement home or assisted living place, so it's a justified expense.
Yeah, perfect.
And I have a question. How did you come to the net income?
Yeah, so the net income, so we know that you were making $1,800 in the Social Security, and then from your late husband, you get the survivor bonus of $3,000. Mr. Garcia, we know that you make $76,000 a year before taxes, and then Mrs. Garcia makes $46,000 from the home bakery. So after taxes, I assume you guys file jointly on your taxes, and then you have your kids as your dependents. So that, I think you net about $5,100 a month, and I believe you're about 3,000 or 4,000. And you have the 3,000, which you only pay a little bit of taxes on at the end of the year. It's like $3,000, so you net as well.
So it's 3 incomes.
3 incomes, yes, that we included. Because with you being a part of the household, like you are contributing towards the expenses.
I noticed here you're suggesting I use my tax refund for the credit card debt.
Yes, sir.
Is it generally a good idea, the higher the better in terms of tax refunds? Is that, when I think about my payroll and stuff like that, what do you suggest there? Higher refunds, lower refunds?
Yeah, so it's kind of up to you. When you start your job, you fill out a tax form, and you choose how much that you want the employer to withhold from your paycheck to go towards federal taxes. So having a higher, refund isn't necessarily a bad thing. It does take away cash from you at first because you're withholding from your paycheck.
Okay.
But then at the end of the year, you get that refund if you're paying over your taxes. So it's kind of up to you. I think in this situation, it's really good because you're paying a large, sum of that credit card debt.
Okay.
But that's definitely something you could look into about, lowering if you want to free up some of the cash.
Savannah, anything? You?
Um,
I'm good, I got a bunch of notes here I wanna.
Yeah.
question on Rosa's health insurance expenses. Can she use the HSA money from Miguel's health insurance? Is she on his health insurance? How does that work?
No, she's not. So because she's retired, she's on Medicaid already. She can't be on Miguel's. So you already, like you said, you're already on Medicaid A and B. So that's covering Rosa's insurance needs.
And with Elena, with her starting to drive, will she be expected to contribute at all to transportation costs?
Yeah, I think that definitely is realistic with the current situation. We do plan to have that car bought fully in cash because we don't want to have that large sort of debt accumulating. But I think it's definitely a good idea. 16 now, especially with how tight college is, it's definitely a good idea to maybe have a talk with her about getting a job, contributing towards gas, and saving for college yourself.
Hey,
Yeah.
thanks so much, guys.
Yeah,
Thanks.
thank you.
Appreciate it.
Lots to chew. Absolutely, we'll let you grab all your stuff and, good stuff. Thanks.
Oh, yeah, hey, they did it all. I just
Yeah.
hang out back here.
Yeah.
Great job, guys. Yeah.
Nice to meet you.
Yep.
Thank you.
Thank you.
All right. Good to meet all of you
Thank
guys.
you so much. Thank
You're welcome. Thanks, guys.
Pleasure.
Yep, pleasure to meet you as well. Thanks. Well, let me just have this group
Sure.
hold
Yeah.
pause just for a
Thank you.
second.
Well done, well done.